All right, so this is the second video for behavioral finance. We stopped in the self-attribution bias. So let me just explain what self-attribution bias is. Self-attribution bias just basically means that you tend to attribute things that happen. If they're good things that happen, you tend to attribute those things to you. But if bad things happen, you tend to attribute those things to somebody else outside, something outside of your control. This is known as the self-attribution bias. So just to give you an example, let's say, this is a simple example. Let's say you bought a stock and you did really well with the stock. You made, 20% on the stock in a year or whatever. Self-attribution bias says that you would tend to say that you did well on the stock because of your investor skills, like how good an investor you are. All right, so you bought the stock, you did really well, made 20% on it over the year. So you end up saying, okay, well, I did very well because of my, stock picking skills, the way I analyze the stock and all this other stuff. Now let's look at the second part of it. If you, bought the stock and then lost 20% over the year, you would end up saying, well, it wasn't my stocks, picking skills. It was, the economy, and that's why I did poorly. It was the Federal Reserve Bank that changed interest rates, and that's why I did poorly. So you're going to end up blaming somebody outside of you for that poor performance that you had with this stock. So this is what they call self-attribution bias. Another example is on your exams, right? When you end up getting an exam and you do really well, you end up saying, okay, well, I did real good on the exam because I studied a lot. But if you do poorly on the exam, then you end up saying, well, the question wasn't fair and the professor wasn't fair and all this other stuff. So this is what they call the self-attribution bias. And I think it's very helpful in explaining, the decision-making of individuals, whether it's for stock markets or finance or for other stuff in life. Self-attribution bias. Very, very cool. Then the other concept that we have is what they call limits to arbitrage. If you guys remember what arbitrage is when you can make money on a trade without taking risk. So arbitrage, if you remember arbitrage is when you can make a profit without taking risk, or what they call a riskless profit. So in theory, in the market, there's not supposed to be any profit opportunities. You can't, make money without taking risk. That's the whole idea. But sometimes, arbitrage, these arbitrage trades might not be profitable because there's some noise trader risk. Okay, so let's say an arbitrager believes that he can make a profit by shorting a stock. Okay, if he shorts the stock and the stock actually goes up in price more in the short near term future, then he might not be able to do this arbitrage trading because of this noise trader risk. So the arbitrager might actually exit the market and not be able to take advantage of this price discrepancy. And he can't take advantage of it because of these noise traders that are out there that are trading based on either, biases, or maybe they're herding, they're following other investors. So sometimes, there's limits to arbitrage. And if there are limits to arbitrage, that means that the price might not converge to its fundamental value. So that's, limited arbitrage. Okay, so that pretty much covers some of the concepts that I want to, go over with behavioral finance. I just wanted to give you a feel of what behavioral finance is. There's a lot more to it than the stuff that I just explained today. But it really is, I think, very important. I really think they're doing some pioneering work to explain some of these price discrepancies. I think if anything that you can get from this chapter is just analyze your own behavior and analyze other people's behavior and how these biases or these heuristics are influencing people's decision making. For example, herding, right? People were pushing up home prices in the recent real estate bubble because they were following the crowd. They were following other investors. What were other investors doing? Other investors were pushing home prices up, were paying more for homes. So this herding behavior actually ended up pushing prices up above their true value, and that's what created the bubble. So you need to recognize if people are herding, if people are just following the crowd. You need to recognize for yourself if you have some kind of bias, if you have a self-attribution bias, or maybe you have a recency bias, you're paying too much attention to recent information. You need to pay attention to see if you're correctly predicting certain events. Are you given the right probability to a possible event? So, for example, what I mean by that, for example, what's the probability of a recession over the next year in 2017, right? Over the next year. If you put the probability at 5%, 5% probability of a recession, is that probability correct, or are you making a mistake? Okay. What if the true probability of a recession over the next year is 10%, or it's 15%, but you're only saying that the probability is 5%? So is your probability correct, right? Is it rational? Is your probability rational, or is it that some kind of bias is actually, changing your calculation of the probability of a recession? So this is very important, because, depending on whether you give a high or low probability estimate for a recession, that's going to influence, how much you should pay for a stock, whether you should pay a lot or you should pay a little bit of money for that stock. So, paying attention to your probability estimates is very important, and making sure that these probability estimates are not biased in any direction. Another thing that I want to show you guys before we finish this section of the chapter is I want to show you this website that you can find, and you can Google it. Behavioral finance. Don't do Yahoo, do Google. I hate using Yahoo. I don't think it's as efficient as the Google search engine. But there's this behavioral finance website, this one right here, behavioral finance. And you can tell that there's some weird spelling going on right here. And this weird spelling is actually the English type spelling. It's not the American version of spelling. And this website is pretty comprehensive. It gives you a whole bunch of, different behavioral finance effects or biases or heuristics, and it shows you some of the research that has been done in this area. So if you look at mental accounting, remember we mentioned mental accounting earlier. Here's mental accounting, and here it gives you a definition by mental accounting. It also lists some of the research that has been, conducted, some of the important research in mental accounting. So, mental accounting is an economic concept established by economist Richard Thaler, which contends that individuals divide their current and future assets into separate, non-transferable portions. The theory supports its individual assigned different levels of utility to each asset group, which affects their consumption decisions and other behaviors. So this is one of the definitions, and I guess it comes from Investopedia. So I don't know, but I guess you guys get the idea. This is a pretty simple concept to understand. And they also show some other stuff. For example, one of the things that you guys might find interesting is sports, right? How do sports influence the stock market, right? In theory, sports, shouldn't influence the stock market. They shouldn't have an impact on people's financial decisions. But some research out there finds that they do. So look at this article. This article shows that the FIFA World Cup has an effect on the U.S. stock market. So that's pretty interesting. Another interesting research is weather. So right here, the weather. Does weather have an impact on the stock market? And they've actually found that it does have an impact on the stock market. So for example, let's say, one of these traders, working on the New York Stock Exchange, goes to work today, right? Will he be influenced by the weather outside? If it's a sunny day, will he be more optimistic, right? And be willing to pay more for stocks? If it's a gloomy day outside, rainy, drizzly, snowing, stuff like that, will he pay less for stocks? Will he be more risk averse if it's a bad day, right? Or will he be more willing to take on risk if it's a sunny day outside? So some of the research has actually found that this is the case. This 2003 article, Good Day, Sunshine, Stock Returns and the Weather, is a pretty famous article. So they've shown some of these things. And there's just like all these different research articles that have shown that some of these non-traditional factors, what do I mean by non-traditional? Factors that are not economic or finance based, influence stock or the stock market. What else? Self-deception, the Super Bowl. Super Bowl's had an impact. The winner's curse, the gambler's fallacy, fear, contrarian, this kind of stuff. So take a look at them if you want. If you have any questions, let me know. And that pretty much concludes our section of behavioral finance, guys. I hope you liked it. I think as I make more and more of these videos, I'll get more efficient and probably do a better job with these videos. But I think you guys pretty much get the idea of what behavioral finance is and how it influences the stock market. All right, thanks.